They say money makes the world go round, but have you ever stopped to ask who built the gears? Because the truth is, most people are playing a game they don't even understand, and the ones who do, the ones who understand how money really works, are the ones who win. The rest are just working harder, running faster, and wondering why they're still stuck. Today, we're pulling back the curtain on 5 truths about money that banks don't want you to know. These aren't conspiracy theories. They're the quiet realities that shape your financial life every single day. Once you understand them, you'll never see money the same way again. Truth number 1, banks don't make money from lending, they create it. Here's something wild. When you take out a loan, that money didn't exist before you signed the papers. It wasn't sitting in a vault waiting for you. The bank created it, literally, out of thin air, the moment you agreed to go into debt. That's how modern banking works. It's called fractional reserve banking. Banks are only required to keep a fraction of the money they lend out, sometimes as little as 0% in today's system, and they create the rest digitally as credit. Every time you borrow, a new stream of money is born. Not from savings, not from gold, not from hard assets, but from your promise to pay it back with interest. That means debt is the product. You are the engine. Banks profit from your belief that money is scarce. They profit from you borrowing, not saving. Every mortgage, every credit card, every car loan, it's not just a transaction, it's money creation. And here's the craziest part. When you repay that loan, the money you paid back gets deleted from circulation. The only thing that remains is the interest you paid, which becomes the bank's real profit. The rich understand this. That's why they use leverage. Borrowing to buy assets that generate cash flow, using the same system banks use, but in their favor. The poor and middle class borrow to consume. The rich borrow to multiply. If you ever wondered why it feels like the system is designed to keep you paying forever, it's because it is. Truth number 2. Your money isn't sitting safely in the bank, it's being used. Most people picture their savings sitting safely in a vault somewhere, like in the movies. The truth is, your money doesn't sit anywhere. When you deposit cash, it stops being your money. It legally becomes the bank's money. You become a creditor. That's right, you loaned your money to the bank, and they can do whatever they want with it. They invest it, lend it, and use it to generate profit. And in return, they give you a fraction of a percent in interest if you're lucky. Meanwhile, they use your deposit to earn 6, 8, 12% or more through loans and investments. And here's the kicker. If everyone tried to withdraw their money at once, the system would collapse overnight. That's what a bank run is, and that's why governments insure deposits up to a limit. They know the system only works if you believe your money is actually there. But the wealthy don't keep large amounts of cash sitting in savings accounts. They keep just enough for emergencies, then put the rest into assets that grow and protect against inflation. They know money sitting still is money losing value. Truth number 3. Inflation is not an accident. It's policy. People are taught that inflation just happens, like the weather, something out of our control. But inflation is not random. It's a design feature of modern economics. Every time more money is created through loans, printing, or government spending, the value of the existing money decreases. It's supply and demand. More dollars chasing the same goods means prices rise. That's why your grandparents could buy a house for what a new car costs today. The currency lost purchasing power not because of time, but because of policy. Inflation quietly transfers wealth from savers to borrowers, from the working class to the system itself. Because who benefits from inflation? The ones holding assets, not cash. Banks and governments actually prefer a little inflation. It encourages spending, discourages saving, and makes old debts easier to pay off with cheaper dollars. But for you the saver, it means the money you worked for buys less every year. That's why wealthy people don't store cash. They store value. Real estate, businesses, stocks, commodities, things that grow as money weakens. They understand that inflation isn't your friend, it's the invisible tax that punishes inaction. Truth number 4, interest rates control behavior, not just the economy. When interest rates go down, borrowing gets cheaper. People buy homes, cars, and stocks. The economy booms, but when rates rise, borrowing stops. Money tightens, markets slow, and people panic. It's not an accident, it's control. Central banks use interest rates like a volume knob on human behavior. Turn it up and everything slows down. Turn it down and everyone starts spending again. But here's the secret. The system rewards those who understand the timing. The wealthy borrow when rates are low, locking in cheap money to buy appreciating assets. The poor borrow when rates are high, desperate to cover rising costs. That's why cycles repeat. Booms and busts aren't random. They're engineered through interest and liquidity. You can't fight the cycle, but you can learn to ride it. When everyone is scared, prices drop, and that's when opportunity appears. When everyone is euphoric, risk hides in plain sight. The rich don't panic during downturns. They prepare. The poor freeze. The rich position. Truth number 5. Money is not real wealth. Money is a claim, not the thing itself. It's paper, digits, or credit that represents value, but it's not value itself. Real wealth is time, freedom, relationships, health, and ownership of productive assets. Banks and corporations don't want you thinking that way, because once you realize true wealth is control over your own time, the power shifts. They want you chasing money because chasing keeps you working, consuming, and borrowing. But once you learn to make money serve you instead of serve it, you break the cycle. Think about it. If you have $1 million but no time, no peace, no control, you're not wealthy. But if you own assets that pay you even while you rest, if you can spend your time how you want, you've already escaped the system. That's the secret the rich have always understood. They don't trade life for money. They build machines that print freedom. When you combine these truths, a pattern emerges. Banks create money out of your debt. They lend your savings to others. Inflation erodes your purchasing power. Interest rates manipulate your spending. And money itself is just a tool. So what can you do with this knowledge? First, stop playing defense. Stop thinking the system is fair. It's not. But you can learn its rules. Start by using money to buy leverage. Invest in things that grow and pay you back, not in things that shrink and drain you. Keep only what you need in cash. The rest should be working for you, not sleeping in a savings account. Understand that inflation is a current. You can swim against it or learn to ride it. Assets like real estate, dividend stocks, or small businesses all rise with the tide. Educate yourself. The more you understand money, the less it controls you. Most people spend their entire lives learning how to earn, but never how to use. And finally, redefine wealth. True wealth isn't just money. It's choice. It's the ability to say no, to wake up and decide how you'll spend your time. If this video brought you value, take a second to like it and share it. It helps more people learn the truths that schools and banks will never teach. Comment below with which truth surprised you most, and subscribe to Quit the Rat Race for more videos on financial freedom, smart money habits, and how to build income that works for you. Because the real secret the banks don't want you to know is this: you're not supposed to stay stuck. You're supposed to wake up. Once you understand how money really works, you stop running on the wheel and start building your own. Disclaimer: I am not a financial advisor. This video is for educational and entertainment purposes only.